I'm here with Asset Management Director Jake Reynolds and Head of Asset Management James Timberson to talk about what's been happening in the Courtiers funds and in markets around the globe between April and June. James, if we can start with you, we're looking at some big numbers and quite a big streak. What can you tell us about the Courtiers funds?
Yeah, so I've got a happy face on for this one because it's been another really good quarter. The Cautious Fund is up 7.5%, Band's Fund up 9.6%, and the Growth Fund is up 11.8% this quarter. And this actually marks the sixth quarter in a row where all three of the funds have had positive returns.
When was the last time that happened?
It happened back in 2012, 2013. It was the first time in about 12 years that we've seen 6 consecutive quarters of positive returns. Now, obviously, you do get a bit of timing things go in your favour. So last year we had the tariff crash, but that happened right at the start of the quarter. So there's time for the markets to recover by the end of the quarter. And even this year, when we saw the Middle East conflict crash, that happened at the end of what had otherwise been a really strong quarter. So that was still positive. But having said all that, it has overall been a really strong period, because in those 6 quarters, the Growth Fund has returned nearly 34%, Band's 26%, the Cautious 19%. So it's been a really, really good time to be invested in these funds.
So we're talking about 6 quarters of positive returns in a row. To put that into context, that's 1.5 years of positive returns. Jake, what's been driving these positive returns over the last quarter?
So it's not just absolute performance that's really good, it's relative performance as well. Like, we don't look at the competition. You know, we were on camera a month ago talking about the 10-year award on the Growth Fund, and that's like ranking us against other fund managers. We need to focus on our clients' objectives and building a portfolio that's right for their goals. So that's what we're focused on. But when you do that, we always say that being prudent pays, and that's what we do when we build up these portfolios that are diversified and try to steer clear of big risks. So the relative performance is really good. The reason relative performance is really good is that a lot of people have just been going with the flows of exactly the big stories that are around really at the moment, which is by the Mag 7, by US tech, and that's been really struggling. Where we have been invested more is smaller companies, value companies. We like to find companies with good fundamentals, and they've done really well this year. Obviously, they're more domestically focused and more interest rate sensitive. So when the conflict between Iran and US kicked off, there was a little bit of give back. This stuff did really well in the first couple of months of this year, but we've got that back now, particularly in June. So smaller companies have been doing really well. Rates are expected to, we're still expecting, taking the UK as an example, we're still expecting 1 rate hike this year because inflation expectations have risen because oil rose. It's now come back down, but there's still high gas prices. So when you have lower interest rate expectations, domestically focused stuff does do better. So small cap value, but EM portfolio has been amazing. So these Mag 7 have been struggling because emerging markets. Sorry. So the Magnificent Seven, so now it's people call them hyperscalers because there's other companies in there. They have these huge capital expenditure budgets, spending billions and billions of dollars on data centers. People are a bit concerned about that. So that's why they're not performed as well, even despite all the excitement of AI. But this has spilled over. So people are noticing that all the picks and shovel plays, and they're called picks and shovel plays because in the gold rush in California, it wasn't the miners that performed well. It was the people manufacturing the picks and the shovels to manufacture, to be bought by people that were part of the gold rush. So the picks and shovel plays we've been really well exposed to because these are companies that are just doing normal stuff that people need. So Samson, I think we wrote about it last quarter, but I don't think it made the video, but it had 3 quarters where it was up nearly 40%. But the last quarter, Q2 2026, it's done 99%. And this is because it makes memory. And Lenovo, another part of our EM exposure, emerging market exposure, is making servers. So they put all the bits together from NVIDIA and Intel and Samsung, and it all goes into a big server stack. Lenovo made that. And so they're up 150% this quarter. So these things have really driven the portfolio forward. And then lastly, this is a bit of a sugar rush because we're kind of sad to see it go because it was paying a huge dividend. But we mentioned that renewables were really good last quarter because obviously oil prices had come up, but the wind was blowing and the sun was shining, so renewables were producing a lot. We had exposure with Bluefield Solar Income Fund, and that's actually been bought out by Drax, the power manufacturer. So that's up about 42% this year. Sad to see it go, because we've got to find something else. But it's good to get 42% return.
Well, it's always nice to talk about what's doing well, especially when you guys are returning positive over 6 whole quarters. There's a lot doing well. What about what's not doing so well?
Well, yeah, I guess, we talked about oil being up 94% last quarter. It's now down 38%. So that's back down to the level that actually we saw at the end of February before the conflict started, which is really interesting because the Strait of Hormuz that kicked all this off being blocked isn't fully operational yet. It's still, there are some ships coming through, but we're nowhere near to the good rate. There was a blip where we thought it was opening up and then went back down again. So but despite that, oil has, we talked about human ingenuity and people pivot really quickly. So Saudi are producing more, and that's brought the oil price back down. But it's not good news across the board because states like Qatar, the big gas exporters, they're really dependent on Strait of Hormuz. They have no workaround. So gas prices are still quite high, and therefore you get energy prices. Countries like Germany will have high energy prices. So what's done badly? Oil means that our energy stocks, particularly a couple in the global fund, haven't done as well. So they held back. I think global fund's still up nearly 6%, but not as much as the other funds that were benefiting from that smaller cap exposure and interest rates coming down exposure. So those also didn't do well. Those interest rate effects have not led to the consumer's pocket yet because energy prices are still quite elevated. So consumer discretionary stocks. So that's companies that make discretionary purchases. The stuff that would fall into that is like house builders or car manufacturers. They're big ticket items that you need to feel really confident about the economy before you take on that debt and you go and buy and purchase that. So actually we have Stellantis, which is Peugeot, Citroen, Alfa Romeo, and Mercedes, and then some house builders. We've got a big pocket of UK house builders as well. I think, there's a massive housing deficit Gary talked about, I think last month on the video. So we are, they're also incredibly good value, and they've got amazing balance sheets. It's not the same as when in the sort of going into the 2007, 2008, where these companies were a lot more leveraged. They're completely deleveraged, healthy balance sheets, and we need more housing.
So we're seeing this steady rise since the 90s of China as a percentage of global total GDP, and that has increased massively. You can't ignore it anymore. James, talk to us about China.
Yeah, so China historically is a region where we haven't been heavily invested at all. Partly because of a lot of investor restrictions and how state controlled it is. And Lenovo, which we mentioned, was our only direct exposure at all until recently. And even then, we only invested in Lenovo because it came up on our shortlist and it's listed on the Hong Kong Stock Exchange, so it's very easy to trade. But in the last quarter, we've sort of paid a bit more attention to China. Its share of global GDP has absolutely ballooned in the last couple of decades. It was 1 or 2% in the early 90s. Now it's nearly 20%. So now, not in being invested in China is a much more of an active position and having some exposure to it. So what we've done is we've dipped our toe in. We've invested in the Hang Seng Index. The advantage of that is it's trades very liquid futures. And we already trade a lot of futures, so there's very little to no setup required. So we've dipped our toe into the Chinese market with this Hang Seng Index. Company makes up 2% of the growth fund, 1.5% of balanced, and 1% of cautious. And we're also looking to build on it by looking at direct stocks, which a bit like Lenovo won't be directly traded in the Chinese stock market because of all the barriers to entry there. It'll be listed in Hong Kong, which is much easier to access.
So I'd like to ask you both, how important is it that you stick to your investment principles as opposed to trying to adapt to all market shifts?
So much of what we do is really simple. It's really simple. It's just not easy to do. And that is,
They know how.
yeah, and I think people are going to cringe at this, but it's having the best clients in the world, because I know, but it is because we are allowed. 2023 was not good for us, but everyone stuck with us because they know, and you have been rewarded so richly since then, because in that period, you've got interest rates going up, equity markets not doing as well, these Mag 7 stocks that there's a lot of retail investors going into. People are saying, oh, I'm making this, what's your Courtiers fund doing? But you know those periods will come, so you have to stick to your process, because the process is based on hundreds of years of evidence on how markets behave and how humans behave, and it doesn't change. Oh, but it'll still be a human at the end of making the decision. What's the, it's ultimately it's avoiding the get rich quick schemes and churning out good returns year on year, and doing it with discipline, because the get rich quick schemes make you get poor quick eventually. And so you just got to build a diversified portfolio, have the margin of safety with evaluation, and just keep churning it out and grinding it out every day, really.
The funds are nearly 20 years old now, and the core risk analysis that goes on behind the scenes, that hasn't changed at all. The basic calculations that we use in our, what we call it, mean variance analysis, that hasn't changed. We still use that process. We still look at the fund betas, we call them, every month. They're a risk rating of the fund. They measure the risk of the fund relative to the market, and all the maths that goes behind that hasn't changed, because it works. And here we are, nearly about to celebrate the 20th anniversary of the funds, and they've all got really good track records behind us.
Well, that's a great note to end on. Both of you, thank you very much. James for your time, Jake for your time. If you do have any questions, please, as ever, contact your advisor or contact us through the website. Thank you.